Hi everybody, this is George Veter, Veter Financial Group, spending a minute with you to help us through this difficult time with the markets being as negative as they have been, especially for the last 6 weeks We have had multiple bear markets through the years. I've mentioned to you one-on-one, most of you, that since the Civil War was over, the New York Stock Exchange opened. We've had 35 recessions, recovered from those 35 recessions to new highs 35 times. So kind of this loop. Also, Forbes came out with some statistics that I thought were interesting. They showed that if you live to be average age, average mortality, you will experience 14 bear markets during your lifetime. As far as the difference between how long a bear market lasts versus a bull market lasts, or when stocks are going up versus stocks are going down, the average length of stocks going down is about 9.5 months. The average lengths of stocks going up is 33 months. So it's about 4 times longer going up. 80% of our life will be spent in bull markets, and 20% of our lives will be spent in bear markets. So if we keep that in mind, at least for me, it makes the unpleasant moments a little easier to get through. We're in the middle of this kind of nasty market cycle. We have the 3 things we're all aware of that have pressured the market. We're fighting inflation and interest rates are going up. Wall Street's worried that the Fed will go up too far, too fast with interest rates and stall out the economy. So we're on an inflation watch. The next thing is that we have COVID in China, which has crimped manufacturing and the speed of manufacturing. Shanghai, city of 25 million people, has been very much crippled by COVID and COVID restrictions, so that further exasperates the concern over supply chain disruption. So we're watching China. And then the third thing we're all aware of is the war in Europe. It's grinding on for all of this year so far, and it's not easy to watch between Putin and Zelensky. Hopefully that gets resolved in the near term, but those are 3 things for the market to be worried about all at once. Now, we know that these things won't stay the way they are, that we will make progress and we'll find solutions and solves, and the world will move forward and companies will grow and our portfolios will once again see green instead of red. But what I want to talk about today is managing the gap between where we are right now and when that next growth period starts. Because there's really no way to identify or pinpoint when the difficult market will cease and the positive market will begin. Part of the reason is Wall Street always looks around the corner. Wall Street starts pricing in what they see 6 to 9 months from now, today. They don't price in the value of the market today. They price in the direction of the market and where they see the market 2 and 3 quarters from now. So there's no way to know when that's going to change. Most recent, we had 2007 through 2009, which was a very difficult, we call it the Great Recession, because it was the most difficult market experience that we had had since the Great Depression. We all remember that, the financial crisis or the subprime crisis. Now, March of 2009, the market started going back up. Now, there was nothing to signify that. We were not out of difficult economic situation. We didn't have any positive data points the day the market turned from negative to positive. It just did. And then if we would have missed that next 12-month period of time, it would have really crippled our averages to date. One of the things that we can do is make sure that we have our emergency fund, which is, we've always preached that we should have, as a rule of thumb, 6 months of household income need sitting in cash. And then in addition to that, whatever we see in the next 12-month horizon that we need for an extraordinary expense, not a monthly expense, but something that's not ordinary. So if we're going to re-roof our house, or if we were going to upgrade our car or do something like that, that's not an ordinary expense, that needs to be sitting in cash along with 6 months of household need. So if we're following the rules and following the advice of having an emergency fund, this is time when we use those emergency funds for those unforeseen things that pop up. The next thing we do is make sure our distributions are manageable, because we've preached for years that you should have a speed limit, a maximum of 5% distribution, right, or less. Then we also want to make sure that we manage our bonds. We have bonds in the portfolio primarily for times like this, and this has been a difficult time for bonds because interest rates going up is bad for bond prices, but bonds have still done better or less bad than stocks so far. Now, we have shortened the maturities on our bonds up. That's something that we can do to manage this gap between a difficult market and a positive market. And managing that gap means that we need to have short maturities on our bonds. So as you know, we've gone to low duration bonds and we've gone to floating rate bonds to be best positioned to be the safety factor when stocks sell off, but still have the short maturities so that as interest rates change, we take advantage of those higher interest rates quicker than we do with longer maturity bonds that are subject to a discount. And if you want more information on that and why we make the changes in the bonds that we have made, please talk to us one-on-one about that, but that's important for this period of time. Another thing that we have that we do is we make sure that we do loss harvesting in our non-IRA accounts. So when values are down like this, if we're at an unrealized loss with any of our categories, we can sell the position that has a unrealized loss, and we can replace it with another similar position so we don't go out of the market, and we can go higher now and have locked in the loss while we're down there. So when the market recovers, our portfolio will not be worse for the wear, but we will have losses to write off against our taxes. When the news flow gets negative, they know that that's disproportionately impactful to people, and it's good for viewership or readership. So when the market gets negative, you hear how horrible it is, and they definitely accentuate that. So limit your time in the negative news cycle. Become aware with what's going on, but make sure that you don't live in that. Because whatever you focus all your attention on gets bigger in your life and in your mind. And when things are negative, you don't want that to get bigger. Focus on what's positive, because there's lots of good things going on in our economy and in our world. And make sure you stay connected to us, because we're the source that has a lot of experience. Again, I started in this business in 1990, been through a bunch of these cycles. So I have a lot of context to what to expect around the corner and how to manage the moment while we're in it. And know that we all care about you. Everybody's invested in safely guiding our clients through this time when it can get anxious for us. So let us help you. Grateful for your business. Look forward to my one-on-ones with you, and I'll look forward to our next communication. Thank you.